2015. As Mark said, my name is Malcolm Joy. I'm an international tax partner in the UK, specialising in value chain and transfer pricing. Very pleased to be joined by three of my colleagues from around the world. Holly Carmichael is an international tax partner with BDO in the US, Kevin Doyle, an international tax partner with BDO in Ireland, and Thomas Kaufmann, who's an international tax partner with BDO in Switzerland. And in today's webinar, we're going to take a look at the impact of recent developments in the world of international tax on value chain structures. In particular, we're going to look at the latest announcements from the OECD as part of their program addressing base erosion and profit shifting, or BEPS, as it's commonly called. So looking at the agenda for today, we're going to start with a look at value chains generally. What do we mean when we're talking about value chain structuring from a tax perspective? We'll then move on to the BEPS action plan from the OECD, looking in particular at the OECD's work on harmful tax competition and the definition of a permanent establishment. After that, we'll take a look at the UK's diverted profits tax, which is an interesting unilateral response to the issue of artificial avoidance of a permanent establishment. Holly will talk us through the impact on value chain structures of some of the transfer pricing proposals that are currently being considered by the OECD. And Thomas and Kevin will provide an update on recent developments in Switzerland and Ireland, two countries that feature prominently in value chain structures. Then Holly will talk us through a US perspective on value chain and the BEPS program before we wrap up with a summary of what this all means for value chain planning. So what do we mean when we talk about value chains and value chain planning from a tax perspective? I think we all recognise that businesses have a value chain. It's a combination of functions, assets and risks that create the value in a business. And from a transfer pricing perspective, we're perhaps familiar with the delineation of these functions, assets and risks to help us identify an arm's length price for the provision of goods and services within a group. And what we're typically doing in a value chain project is taking a more holistic look at the functions, assets and risks and seeing what the commercial and tax implications are of changing the way the functions are carried out or moving the assets and risks to different locations. And in particular, if we can move more of the functions or the assets and risks to lower tax jurisdictions in a way that is aligned to the commercial operation of the business, then the result should be a reduction in the group's effective tax rate. At this stage, there are a couple of important caveats to throw in. Firstly, it is absolutely paramount that the tax structure is fully aligned with the commercial structure of the business. If it isn't, then there will be tension between the two, which will lead to uncertainty and ultimately to tax risk. And many of the tax problems that we see these days faced by multinationals have resulted from tax structures being implemented which are not aligned to the commercial structure, or situations where the commercial operation, the commercial structure of the business has evolved, it's moved on, and the group has not taken the time to check to see if the tax position is still aligned with that commercial operation. As we'll see in a post-BEPS environment, this will be even more important. And because of the need to align the commercial structure with the tax structure, it's extremely rare for us these days to see value chain tax planning take place in isolation. It almost always comes as a result of commercially driven change. And this may be from businesses moving into new markets, it may be from businesses changing the way they supply or provide goods or services to their customers, or it may be from post-merger, post-acquisition integration. A variety of different ways that businesses are changing, but change is happening on a very frequent basis, and aligning that change with the tax structure is the way that tax efficiencies can be built in to the business. So the second important caveat to remember is that a value chain project is going to require input from a range of tax specialists. We'll talk a lot today about transfer pricing, but it's not just transfer pricing. There will be a number of issues around corporation tax, on exit charges, potential for exit charges as assets are moved around the world. Also questions around the creation of permanent establishment. And clearly, if we are moving or changing the way that we supply goods or services, then there will also be customs duty and VAT issues to consider. And frequently there will be people moving around the group as well, and we will need to think about the expat tax issues or global mobility issues associated with those moves. In the old days of value chain planning, the focus was often simply on the intangible assets of the business, and many planning structures which originated typically in the US, in the west coast of the US, where there were large amounts of high-value intellectual property or intangible assets, it was recognized that these intangible assets were very mobile, and often it was considered that a simple internal contract was all that was required to transfer the assets from the US into low-tax jurisdictions or zero-tax jurisdictions such as Cayman Islands or Bermuda. So that was in the very early days of value chain planning, but it quickly became more sophisticated, with multinationals changing the way they carried out other core functions, such as some of the ones we've got listed in the arrows in the middle of that diagram, the procurement, manufacturing or distribution functions. And what we're going to do in the next couple of slides is just take a quick look at two of those areas, manufacturing and distribution, in more detail. So first of all, looking at the manufacturing function in a group and possible ways of sharing the activities and risk between the head office company, which is shown on the top row of boxes in this slide, and the manufacturing subsidiary, which is shown in the second row of boxes. And if we look at the left-hand side of the chart, we have a very centralized way of operating, with the head office company, which we've described as a principal, taking on a lot of the responsibility and the risk for the manufacturing. The manufacturer, which we've described here as a toll manufacturer, if we're at the far left-hand side of the chart, would merely be carrying out some kind of service-type activity. So the ownership of raw materials and partly finished goods, and a lot of the risks around the product itself would sit with the principal. And the result is that the toll manufacturer is carrying out the service-type activity and expecting to achieve a stable but lower level of return than the fully-fledged manufacturer on the far right-hand side of the slide. And obviously, if the head office company is located in a low-tax jurisdiction, but the manufacturing entity is in a higher tax jurisdiction, then there is a tax advantage expected to be achieved from being further to the left of this spectrum. And the boxes in the middle just represent alternative positions on the spectrum. If we look now at distribution side of things, then slide 5 looks at a similar range of options for a distribution activity. Again, on the left-hand side, we've got the head office company taking more risk, being more entrepreneurial in the way it operates. And the local selling entity on the left-hand side is very light from a functional perspective, acting merely as an agent or as a commissioner, and is therefore expecting to achieve a much lower level of return than the fully-fledged distributor on the right-hand side of the page. Typically, what was happening is that groups were setting up principals in low-tax jurisdictions, such as Switzerland, where they could benefit from a tax ruling, and very low levels of profits were being left behind in the jurisdictions where the sales were actually being made. Part of the objection from government and tax authorities to this kind of structuring was that some groups were taking it to extremes, and principal structures were sometimes being created where there was no real substance in the principal location. Risks were being allocated to companies that had no real ability to control the risk, and value chain planning was being combined with other slightly aggressive forms of tax planning and base erosion, such as the use of hybrids. So a lot of the profits were falling outside the tax net altogether. Now, before the base erosion and profit shifting program was launched by the OECD, there was little in the way of guidance to tax authorities or to taxpayers on how to approach a value chain structure. And the first proper guidance we really had came out in 2010 with Chapter 9 of the OECD guidance on transfer pricing guidelines on business restructurings. And not only was this helpful to tax authorities, but it was also helpful to taxpayers, as it gave them more certainty on some of the grey areas around value chain reorganisations themselves, such as when compensation payments were due to companies that within a group that were affected by the reorganisation. But the G20 still felt that a more comprehensive and joined-up approach was required, and in 2012 they announced the Base Erosion and Profit Shifting Initiative, which they passed on to the OECD. And the OECD launched this BEPS program with 15 actions under the headings of coherence, substance and transparency of the international tax system. And the actions were spread over a 2-year period, and we're just over halfway through that 2-year period. We're going to take a look in more detail at the actions that have probably the biggest impact on value chain structures, namely Action 5, which is harmful tax practices, Action 7, the definition of a permanent establishment, Actions 8, 9 and 10, which deal with particular aspects around transfer pricing, and Action 13, which covers transfer pricing documentation and country-by-country reporting. One of the questions we will be considering is to what extent value chain planning has a future. So at one level it looks as though it's under a lot of challenge, or at least a lot of scrutiny, but at another level it's the greater guidance and sophistication that we now have around the approach to value chain structuring could mean that there is a lower risk, greater certainty and greater longevity around this kind of structuring, provided, of course, that the tax position is aligned to the economic substance. And that's a theme that's going to be coming out a lot in this talk. And also, given the greater challenges to other traditional cross-border planning techniques, such as the use of hybrids, it may be that value chain structuring is one of the few remaining ways of addressing a group's effective tax rate in a sustainable way. So let's have a look at the progress on the action plans in more detail, starting with Action 5 on harmful tax practices. As with much of the work on the BEPS action plans, the working group on Action 5 was keen to build on the previous work by the OECD, and in particular the work of the Forum on Harmful Tax Practices, which began in the late 1990s. The two other stated aims, apart from building on the previous work, the two other stated aims that have come out of the Action 5 work are that they want to ensure that if there are any preferential regimes, they include a substantial activity requirement. So it's interesting to note that they're not against preferential regimes per se, they just want them to include this substantial activity requirement. And they want to improve the information flow between tax authorities on rulings that have been given. So as well as the work that's been carried out by the OECD in this area, there have been a few other moves to encourage tax authorities away from rulings and preferential regimes. One of the most eye-catching ones was the challenge last year by the European Commission to the governments of Luxembourg, Ireland and the Netherlands on the transfer pricing rulings given to Fiat Finance, Apple and Starbucks. And the European Commission wrote to the finance ministers of these countries setting out in quite a lot of detail how transfer pricing worked and how they would expect a country to go about reaching an advanced pricing agreement, and arguing that in the instances they mentioned that the tax authorities had failed to be as thorough and as diligent as they should have been. Interestingly, the challenges were mounted under the guise of potentially illegal state aid. And Kevin, perhaps if I could bring you in at this point, because I know that in Ireland this challenge has received a lot of publicity, and perhaps also interesting to hear from you at this point on the latest developments and where you're up to with the knowledge development box.
Yeah, sure. Thanks, Malcolm, and hello, everybody. I suppose just in terms of Ireland and Action 5 itself, the opinion on the ground here is probably that the substantial activity and transparency already underpin key tax policies such as the 12.5% rate on trading profits. But when it comes to the EU state aid case and Apple for Ireland in particular, it's not about an incentive or a regime per se, but as you say, it's the Irish Revenue's agreement to transfer pricing policies that were put forward by Apple in 91 and 07, and whether or not the arm's length principle was adhered to. I think without further detail to the case or the findings at this point, there's probably not a lot more I can say other than to note that since 07, Ireland has actually brought in dedicated transfer pricing legislation, and the Revenue recently announced its intention to enhance credentials as a competent authority for transfer pricing purposes. Maybe the knowledge development box and the impact of Action 5 is more pronounced. We do have a consultation paper released by the Department of Finance at the moment that acknowledges the modified nexus is most likely going to be adopted. So there's now a keen focus here in Ireland on the further guidance promised by the OECD on the definition of what would be qualifying IP and substantial activity. And I suspect that in turn, given all of this activity and the spotlight that the likes of the EU challenge put on Ireland and other jurisdictions, that any legislation we bring forward for knowledge development box as a regime in itself will go forward to the EU for pre-approval. So I think that's probably the impact it's having on the ground here.
Okay. Thanks for that, Kevin. I think, as we can see from that, it looks like preferential regimes will still remain part of the tax landscape, but very much subject to the substantial activity modified nexus approach that we have been talking about. So on to slide 9 and action 7 next, and the avoidance of permanent establishment, or PE, status in a country. The OECD's discussion draft from action 7 was released in October last year, and it was clear that there were 2 main areas of concern. Firstly, where substantial sales were taking place to customers in the country, but where a permanent establishment was being avoided by contracts not being concluded there, or possibly by the use of commissionaire structures. And secondly, where multinationals were deliberately restricting their activities so as to make use of the exemptions in Article 5, subsection 4 of the Model Convention. For example, restricting activities to preparatory or auxiliary activities, or relying on the exemption for mere warehousing of products. And sometimes groups were doing this by splitting the functions in quite an artificial way. As we can see on this slide, the proposed wording for a changed definition of a permanent establishment is very vague, and this is causing a lot of concern. I think whilst the business will generally know where a contract is being concluded, how easy is it for a business to identify if a group company is habitually engaging with specific persons in a way that results in the conclusion of a contract? Quite difficult to tell. So a lot of concern over the proposals in the discussion draft on Action 7. I think there's a long way to go with this action. The work is very closely linked with Action 1 on the digital economy. But what we do know is that groups with commissionaire structures or groups with toll manufacturers clearly need to pay attention and look out for changes coming through. If a change does happen to the definition of PE, then it's likely to be introduced by the multilateral instrument, which could change many tax treaties in one go. And this is being dealt with under Action 15 of the BEPS programme, unlikely to be introduced before the end of 2016 at the earliest. However, I think there is concern here that the proposals for reform of the definition of PE won't achieve universal support. And I think this is one of the factors behind the UK's decision to take a unilateral approach and come up with the diverted profits tax. So just moving on to have a quick look at the UK's diverted profits tax proposals in more detail. This is a tax that will be levied at the rate of 25%, so greater than the UK's mainstream corporation tax rate of 20%, levied at the rate of 25% on profits in 2 circumstances. Firstly, where we have an artificial avoidance of a permanent establishment, and secondly, where a UK company has parted to arrangements with an offshore person that lacks economic substance. The tax is designed to be outside of the UK's corporation tax system, and therefore, at least in the eyes of the UK government and Her Majesty's Revenue and Customs in the UK, they are thinking that this will not be subject to treaty override or any competent authority procedures. Legislation is being rushed through. We only had our first sight of it in December of last year. It's due to be passed in our Finance Act by the end of March this year, and it will be effective for profits accruing from 1 April 2015. It's probably easiest to explain the principles of how it would work through a couple of examples. The example I've got on the chart here, on the slide here, is a foreign company that's making sales to UK customers, and if the foreign company does not have a permanent establishment in the UK, either because contracts are not being concluded in the UK or because we're using a commissionaire type arrangement, then if there is also either a tax mismatch or a tax avoidance motive, then the profits arising from those sales could potentially be brought within the diverted profits tax regime and taxed at the rate of 25% in the UK. second scenario is where we have arrangements with an offshore entity that lacks economic substance. And the situation we've described on slide 14 is where we have a foreign IP owner that has that owns IP that's been developed in the UK. It's paid for the development of that IP through arm's length remuneration for some contract R&D services. But the foreign company has very limited substance, and the UK company has all the substance. Now, what the structure describes here is a situation where the UK trading company on the right-hand side of the diagram and the overseas trading companies in the group on the left-hand side of the diagram are paying royalties into the foreign IP owner. But if this meets the conditions of the diverted profits tax, so if we don't have enough substance in the foreign company and there is also a tax mismatch, so there's effectively less than 80% of the tax paid in the foreign company than would have been paid in the UK, then we look at what the alternative arrangements might have been. And in this situation, the alternative arrangements might well be that we ignore the foreign ownership of the IP, we deem the UK company to be the IP owner, and the royalty is paid from the UK trading company on the right and the overseas trading company on the left, are now deemed to arise in the UK company and taxed at the rate of 25%. So as we can see, quite radical proposals from the UK. There may well be some minor tweaking and changing of those before they become enacted in law, but they will become enacted in law very shortly. So at this point, I was going to hand over to Holly, for Holly to talk us through some of the transfer pricing changes that are being proposed by the OECD.
Absolutely. And Malcolm, thank you. We're on the next slide, which was what I was about to ask. We actually move into what I perceive as the heart of BEPS here. And I think it's also the heart of a lot of value chain planning, as Malcolm mentioned, where we do spend a lot of time on trying to locate functions and risks in tax-efficient jurisdictions that, of course, align with what your business purposes are. Within BEPS, taxing profits where the value is created is one of the three foundational pillars that they say that they're trying to accomplish. And this is really driven by the concerns that tax laws don't move as quickly as business moves. A lot of tax laws are left over from days when they were very focused on just a local country as opposed to a multinational operation. They do not anticipate the fluid kind of movement of capital that we have today, and in particular, the effect that the digital economy has had on business. It really alters the landscape to be able to have a sale concluded and even negotiated from literally anywhere in the world, and also a world where widgets aren't the primary thing that we're selling. It's very often an intangible, whether that be in the form of a true intangible, a service intangible, but these are things that tax laws really were not originally written to encompass. And so the OECD is concerned that this has provided taxpayers with, in their language, these quotes are from the OECD, but gaps that can be exploited to generate double non-taxation, which frankly is a phrase that I love, double non-taxation. But that last quote that is bolded and italicized there really highlights the atmosphere that the OECD has taken. They're frankly very valid concerns that the tax laws are out of step with the emerging economy and these changes that are not so new to us but are still new to tax law evolution, where they start using this unusual morality language, fairness and integrity. And the conversation, both in the OECD analysis and hearings that they've had, as well as in these draft reports they've been issuing, really underscores that the question is no longer whether structures and planning complies with the rules, but whether taxpayers are paying a fair share of tax. So that all feels a bit like doom and gloom. But I think if we take a look at the right-hand column here where we have the solution they're proposing, I suspect that most, if not all of us on this call and in the tax community could get behind these objectives, which are to ensure that profits are taxed where economic activities that are generating the profits are performed and where the value is created. That's precisely in line with what we've all been trying to do with value chain planning. And it also says that they're really striving to increase certainty. by standardizing some requirements and reducing disputes. That's clearly something that is of great desire to every company, is to reduce that uncertainty. The challenges here are, in arriving at these solutions, that the OECD has no lawmaking authority itself, and so standardizing rules will require the building of an awful lot of consensus and law change and harmonizing very disparate tax regimes. And on that first point of making sure that profits are performed where the value is created, also getting some consensus on what actually generates the value. And that leads us into the next slide, which they've kind of broken this out into 3 different areas. We've got actions 8, 9, and 10. 8 focuses on intangibles, 9 is risks and capital, and 10 is other. We have drafts on most of these, and it's a little bit misleading to say that the intangibles draft, which is shown as a blue final delivered bullet, that was a final delivery, but a tremendous amount of it was in draft. The pieces that are in draft, I think, are the ones that are the most debatable, and so we'll certainly have a few moments here to talk about those. Over on the area 10, the other high risks, there's some interesting things going on in the other category as well. We do have I think it will end up being a semi-final draft on services, and I think that really goes towards the simplification objective that we have. And the challenge, though, there is that it's at a bit of odds with U.S. rules. I think I will let Malcolm or whoever is driving our slides flip us onto Action 8. Thank you. So Action 8, this, I would really enjoy spending a few hours talking about this, but I will not, because I know that we all need to move on with our days. But this is an interesting draft report that the OECD has issued. They have definitely defined intangibles, and I think that it reflects greatly the input from the U.S. delegation, in that definition of intangibles very closely mirrors what the U.S. has always ascribed as the definition of intangibles. And so we have good consistency there, and I think that that's helpful for all of the tax authorities to potentially get on the same page in terms of what we're even talking about when we start a conversation about intangibles. But they then went on to, in many people's view, redefine where and how value is created. The current predominant view is that whoever economically assumed the risks merits the long-term reward. And you'll see that in many value chain planning structures where you will appoint one of the entities as the principal, the one that's going to invest in an ongoing project, will assume the risk of loss, and will ensure that other parties in the transaction will get a guaranteed rate of return, or at least will break even. There's a shift in view in this updated guidance to Chapter 6 of the OECD Transfer Pricing Guide, which is contained in the Action 8 draft. And that shift kind of re-characterizes that sort of person or that sort of principle into a mere financing party. And so it gives it just a financing return and shifts the risk and profit back out to the people that are actually doing the work. So this starts, I think, prompting, if finalized, a very significant review of value chain structures that are using cost-plus arrangements, for whether that be for R&D services, for marketing services, any valuable services. And it also greatly impacts the structures that Malcolm referred to earlier that are also called cash box structures throughout this whole OECD exercise, where a principle doesn't actually have any substance in it. So this Action 8 of intangibles could have a very significant impact on value chain planning and would require certainly a refresh and a rethinking of where different functions are actually contained. If we can take a peek at Action 9 on the next slide, this is also a draft, and it also has impact on value chain planning because, as was mentioned before, this allocation of risk is often done contractually. many risks don't ever happen until there's a liability that arises, and so fixing that liability is frequently done, certainly in a related party context, as well as at arm's length, through legal assignment of that risk and determining which party will actually end up having to pay that kind of liability when it comes. But the OECD has made in this draft on Action 9 the observation, or the mandate, shall we say, that contractually allocating core risks, and I think there's a debate around what risks are core and which are not, but that allocating that is not meaningful unless the party that it's allocated to has the ability to actually control the risk. There's a lot of debate in the tax community about the OECD's ability to enforce that kind of a concept, because at the end of the day, a legal contract is a legal contract, and if a party is actually legally liable for something, it's difficult to envision how that could be not recognized or recharacterized. There's also some commentary in this Action 9 draft around recharacterizing or not recognizing transactions that don't have fundamental economic attributes of the kinds of arrangements that they would find between unrelated parties. And my personal opinion, and I've heard this echoed throughout the tax community as well, is that this is a bit of a self-serving statement, because many related party arrangements truly have no unrelated party equivalents. And so if I have to have an unrelated party equivalent in order to be respected, this becomes very difficult to have certainty, which sort of, you'll see the circle here. It takes us back into, so if your objectives, OECD, are to give us certainty, then we need to have clarity in definition and in standards. And it's a difficult task, and they've certainly taken a good cut at it in a very short period of time, but some interesting questions are being raised that clearly go to the heart of value chain planning. On Action 10, we have a few other items that are mentioned. I think the most substantive to date are really the service proposal, which would go greatly to simplification. It is at odds with the U.S. service regs, so I think it remains to be seen how quickly it's adopted and how quickly we can get harmony across all of the countries. A somewhat fascinating, in my view, draft report, and I would put quotes around a report, on profit splits was recently issued. That really is just a question. It's a list of questions from the OECD about whether or not profit splits should ever be used. And I don't see that as being a significant impact on value chains unless they come back and say, yes, we should be using profit split everywhere. The reality is that we generally, in order to obtain certainty, try to steer clear of profit split. So it certainly seems, and I know I've heard from OECD officials themselves saying that they're just trying to explore whether or not profit split is an effective tool that we should be using. Action 13, which I now get to skip on to, that goes over into the transparency side of the world. And there's a huge amount of information that is available for taxpayers to be thinking about Action 13, which is the country-by-country documentation. This was the first report that was issued, and of course it does require local country implementation. It's effective January 1st of 2016, so that would mean in 2017 would be when all of the reports need to start coming through. A number of countries have stated or have actually said that they are adopting this. The U.S. has not, and there is an interesting debate in the U.S. as to whether we even have the authority to do so without going through Congress. But I think that the takeaways here are that these information requests are much broader than just focusing on your local country's data. When you get into the local file, it will be requiring much broader information than I think anyone is used to. And so the exercise that companies are going through now, which we highly recommend, is to assess what information gaps you have and start thinking about the budget and the headcount that might be required to fill that. Of course, BDO would be happy to help you make that assessment, and there is a link at the bottom of this particular slide on slide 21 that you are welcome to take a look at, which links you to our recent webcast on the country-by-country reporting and gets you much deeper into the detail. Thomas, I believe that means you are next up to bring us to your lovely country and tell us what's going on there.
Thank you, Holly. Good afternoon, everybody. Let's have a closer look what's happening in Switzerland. Can I have the next slide, please? Okay. Since 2007, Switzerland's privileged taxation for holding companies, mixed companies, domiciliary companies, as well as for principal companies and finance branches, has been under increasing international pressure, mainly from the EU. They qualified these company statuses as forbidden state subsidies. The reaction, Swiss reaction, finally came in December 2013 when the Swiss Federal Council issued the final report on measurements to strengthen competitiveness of the Swiss tax system. As part of the corporate tax reform 3, the Swiss federal government proposed to replace the privileged statuses of these companies in the next 5 to 7 years, but with an additional series of measures which could help to maintain Switzerland's preferable status. The consultation draft of the corporate tax reform 3 has been issued to political parties, interest associations, and to the Swiss cantons on 9th September last year. So if everything runs smooth with the legislation process, the new law might be enacted in 2018-2019. Now, what are the suggested measures of the corporate tax reform 3? First of all, and probably one of the most important ones, is a step up during the transition period from the privileged taxation status to the ordinary tax status. So we're going to have a tax-neutral step up of the hidden reserves to market value, and that only in the tax account, not for local GAAP purposes. And the step up is in relation to the taxation quota of the before privileged taxation. So for example, if you had a 10% tax quota, 90% will be eligible for the step up. Now the interesting thing, the stepped up values can be depreciated for tax purposes within the next 10 years. So that gives you somehow the possibility to maintain your previous tax rate for the next 9 to 10 years. Another important measure is the IP box. The definition of what we would call IP box in Switzerland is not consistent with Article 12 of the OECD model. So it's not including trademarks and rights, designs, trade secrets, know-how, and such things. Substance requirements are quite big. It's a little bit the same as the ongoing discussion with BEPS. So you must have a contribution to development and the control of the development, finance and strategy within Switzerland with dedicated and capable people. The so-called modified nexus approach might be favored. Qualification of the calculation of the qualifying income is such that up to 80% of the taxable income will be reduced on the cantonal and communal level. So the effective tax rate is expected to be approximately 10%. Other measures will be the notional interest deductions. That's quite a common feature, which you know probably from other countries in the EU. So that's a tax equality for debt and equity at the corporate level. And you're going to have a fictitious interest deduction on the so-called security equity. Important thing as well is the improvement of the current participation exemption. We now have an indirect method, and that is changing to a direct exemption method. Furthermore, there's going to be the abolition of stamp duty. We still have a stamp duty of 1% on contributed capital or assets, which can be quite burdensome if you want to set up a company in Switzerland, especially with IP, which you put in. And we will have unlimited period to carry losses forward. Up to now, it's limited to 7 years. That should be abolished to an unlimited period. And last but not least, the lowering of cantonal taxes is introduction. Well, that depends on the reaction of the cantons, because it's in their autonomy to decide on that. They haven't been not too positive so far. However, we think it's possible that we're going to have an effective tax rate which will be between 12 and 14% for some cantons. And there could as well be a reduction of the cantonal capital tax rate, the annual tax on the equity, which we have in Switzerland, or a participation exemption on the capital tax. Well, what does it mean for the special companies which benefited from all privileges? For example, the holding company. The holding company will definitely benefit from the change to the direct participation exemption. The big feature that will be that in the end, the dividend income and capital gains will no longer consume the net operating losses, which was the case under the old indirect method. If the holding company has as well a finance function, the company could benefit from the notional interest deduction. And if as well there has been some IP, generating IP or development of IP in the holding company, it could qualify for an IP box. The mixed company, if you say just a trading company, could surely benefit from the step up of the assets and the general lowering of the cantonal tax rates. A principal company as well, there the most important thing should be probably the step up of the assets. Many principal companies had IP in it, which they used for the whole group. So the IP box could be a solution. And as well, there we would have the benefit from the general lowering of the cantonal tax rates. The finance branch, that's clear financing. The main feature there will be the notional interest deduction and as well the general lowering of the cantonal tax rates. With these measures, we think that Switzerland could still be an attractive place for principal companies and headquarters. Kevin, that was about Switzerland. Now, change over to Ireland. Kevin, please.
Thank you, Thomas, and hello again, everybody. So, where's Ireland in terms of value chain and tax policy? Well, mindful of the BEPS agenda, the government in Ireland released a roadmap for Ireland's tax competitiveness as part of Budget 15. Based on that roadmap, the three key elements of Ireland's corporate tax strategy are now rate, regime and reputation. On regime and reputation, Ireland has a transparent corporate tax regime aimed at competing fairly for sustainable FDI. On rate, it's the well-marketed 12.5% for trading profits, which the Minister for Finance reiterated will not change as it is now settled policy. I think local policymakers and business people alike here in Ireland were pleased to hear certain foreign influencers acknowledge the rate, such as Pascal Sanaman, who said the single Irish, meaning the 12.5% rate, will be very attractive in a post-BEPS environment. Next slide, please. However, with reputation in mind, last year's budget also announced the phasing out of what is known as the double Irish. Irish tax residence rules had allowed for certain situations where Irish incorporated companies could be managed and controlled outside of Ireland in a number of non-tax treaty jurisdictions as part of IP structures. The Irish rules have been amended so that companies incorporated in Ireland since 1 January 2015 are Irish tax resident by default. The previous law is grandfathered for 6 years to 31 December 2020 for companies that were incorporated by the end of 2014, unless there is a change of ownership and a major change in the nature or conduct of the business before then. It may be worth highlighting that Ireland's tax treaties continue to supersede Irish domestic tax law. So, say you have an Irish incorporated company that is Maltese tax resident under the Ireland-Malta Treaty by virtue of its place of effective management and control, then that company, regardless of when it was incorporated, should be considered Maltese tax resident. Looking ahead with a spotlight on onshore IP exploitation, on the next slide please, we're finding, next slide please. Yeah, we're finding that many multinationals, I suppose, now want to explore onshore locations that can support substance requirements associated with their commercial activities, such as the access to suitably skilled workforce. Ireland's technology, digital and pharma hubs and clusters continue to grow, so the Irish tax policy aims to provide a suite of incentives to support the smart economy. That suite of incentives is made up of IP depreciation, refundable tax credits and a proposed best-in-class knowledge development box, which I spoke about earlier. They're all underpinned by the low corporate tax rate of 12.5%. The definition of IP for depreciation purposes is very wide and includes copyright, know-how and customer lists. Since 1 January 15, the previous cap on the tax-deductible depreciation amount has been removed, so there is now the potential to pay no Irish corporation tax under the IP depreciation regime. Ireland also offers a refundable R&D tax credit at a rate of 25% of qualifying expenditure. So if there is little or no tax payable in Ireland, the cash benefit of the credit still comes back to the company. As mentioned earlier, there's a public consultation ongoing at the moment on the proposed knowledge development box. The rate is yet to be decided, but we understand it is unlikely to be above 5%, and legislation could be available later this year to bring it into force by 2016. So, putting those released together, you might get something like an onshore IP exploitation company that carries on R&D activities as well. It could get the IP depreciation on IP acquired from its parent company or the likes, and a refundable R&D tax credit. Down the line, when depreciation has ceased and any losses forward are utilised, it might be capable of opting into the knowledge development box. So that's probably where we're looking in the future for IP, onshore IP for Ireland. Thank you. Holly?
So, moving into the U.S., which I think really has prompted an awful lot of the BEPS concerns, the U.S. multinationals that have structured, often using Ireland and also using Switzerland. Surprisingly, despite the fact that the U.S. firms were often targeted, the U.S. Treasury representatives were initially quite quiet in the first probably 18 months of the whole BEPS process. But we have seen in the last year significant engagement on the U.S. side and an awful lot of public speaking and exchanges with the individuals from U.S. Treasury that have been directly involved in this process. So we've been starting to get a lot of visibility as to what their personal desires are, and they've been very clear that they are not fond of cash box structures, which of course are largely facilitated by our own rules that allow us to classify entities in a particular way and were made so much easier about 20 years ago with the check the box regulations. So Treasury has said that they're not very happy with that. They've also been very vocal about their distaste for hybrid arrangements. I will note, however, that hybrid arrangements are also allowed by U.S. law, and the classification of certain payments as equity payments that are not taxable is something that's deeply embedded in U.S. law. So while their distaste for it is understandable, it places taxpayers in an interesting dilemma to hear that the U.S. government does not like their own rules, or at least the outcome of their own rules. They've also stated something, again, that I think we all could get behind, which is a very clear desire for airtight transfer pricing compensation of local activities. That really means that we need to have substance. Substance alongside our principles, substance alongside the risk takers so that they can actually manage those structures. The laws, though, need to be changed for any of these things to happen. And that's really been the dilemma from a U.S. standpoint is that while Treasury has been very vocal on these things, and we can go to the next slide, but while Treasury has been very vocal on all of these things, Treasury does not make law. Here in the U.S., we have to go through Congress, and our president needs to sign, or else we need to have enough in Congress to override the veto. And our Congress has not been terribly productive in terms of getting law passed. And accomplishing these things would really require some very significant overhaul to our entire tax regime here in the U.S. So I think we're all standing by in the U.S. and we are watching some very refreshingly vigorous discussion on lowering the corporate tax rate. Of course, the U.S. tax rate is very high in contrast with most of the other developed nations. And that, of course, is driving the behavior of structuring in the way that the OECD is trying to combat. So that would be an interesting outcome if the U.S. tax rate, corporate tax rate, would actually come down. But we need to balance that against currently an unwillingness to reduce the overall revenue or to make up that lost revenue through other routes such as personal rate. None of the proposals, while there's a lot of discussion, none of the proposals are really getting any traction yet. So we're all standing by, certainly watching things. I do think that in the 2016 election, when Congress turns over again, we recently had a change so that a different party was in control of Congress. We will have a new president in place at that point, and that could very, very well change the landscape, or it may keep things at a gridlock. But until then, there's a cartoon here on this slide that most of us in the U.S. could probably sing the song for, but until then, these proposals are just a bill sitting on Capitol Hill waiting to become a law.
Thanks for that, Holly. I'm slightly disappointed that you didn't burst into song there at the end, but maybe next time. So just looking overall at where that leaves us with value chain planning, well, I think as I implied earlier on in the talk, I think value chain planning as a way of managing tax still has the future. The landscape is changing, and clearly there does need to be a lot of greater focus on the alignment of tax with economic substance or economic activity. But countries are still introducing preferential regimes, as we've heard there from Switzerland and from Ireland, and also, interestingly, the US thinking of lowering its headline corporation tax rate. Countries are competing on tax rates to attract businesses. There is now much greater guidance available to taxpayers and tax authorities, and there's no doubt that greater sophistication and attention to detail will be required on these structures in the future. But the result should be, I think, lower risk and more sustainable tax-effective structures that are more effectively aligned to a business's commercial operations. So that takes us to the end of our presentation. Now, we have been getting a lot of questions actually coming through as we've been presenting the slides here. So I'm just going to pick out a couple of them in the remaining minutes that we've got left. First of all, there's a question here around PE risk, and I think this is a question that came in during the presentation on the UK's diverted profits tax. The question was, if a PE is being created by a toll manufacturer or a commissioner, then what is the real risk if these PEs are being remunerated with the correct transfer pricing approach? Well, I think the answer to that is that the risk should be low if the transfer pricing is appropriate and supported robustly. The key will be effective disclosure, particularly as required under the diverted profits tax rules. But we are expecting more details of how that disclosure will work and exactly how that interaction with transfer pricing works in the finance bill when that comes out shortly. So we are recommending that attention is paid to the transfer pricing documentation in particular as the new rules come out on the diverted profits tax in the UK, as this is expected to be an area where there is increasing focus. A second question which came in was around transfer pricing and commissioner arrangements. The question was, if we've heard that transfer pricing risk has increased around commissioner arrangements, where sales support activities are remunerated on a cost-plus basis. Do we agree? And I think, yeah, this is very much a concern that we've heard widely of late. Sales activity which generates sales in a particular country, but where the contract is not concluded in that country, are, I think, much more likely to be looked at closely in the new environment. The challenge is really whether the commission or the target margin, a commission or a target margin may be a more appropriate way of remunerating that activity. And interesting to see the OECD's papers on risk and recharacterization, and also the paper on the digital economy. They're quite illustrative of the debates that are going on in these areas, and I think that's something that we're going to need to watch closely. But in the meantime, I think it all comes back to fairly close review of the functions and activities of those sales support type of operations, and just keep an eye on, can they really genuinely be regarded as something that would be remunerated on a cost-plus basis as a support function. And I think that's where a lot of companies have got it wrong, that they've originally set up something intending it to operate that way, and then the business development people have exceeded the boundaries and created problems from a PE and transfer pricing point of view. And we've just got time perhaps for one more question before we bring this to an end. Interesting question, this one. Economic substance is clearly a key issue. Are we any closer to a definition? This is really something that's quite an interesting question, and it's something the OECD are very much wrestling with, and there's a number of different areas where it comes up. It's come up in the paper on risk and recharacterization. It's come up in the Action 1 report on the digital economy. It's come up in Action 5 on harmful tax practices. It's come up in the work on intangibles, and it's come up in the work on profit split. But I think probably the answer to what is an appropriate amount of economic substance is going to be based on what's appropriate for that particular industry. And it will rely heavily on the functional analysis type approach that we are more familiar with in transfer pricing, who manages the functions, who, more importantly, is capable of assuming responsibility for the risks that exist in the business, and who is responsible, accountable, consulted and informed. And that they will be looking at questions like what in a third-party situation would or could reasonably be outsourced to a third party, and what are the real crown jewels of the operation that a company would never let go of and would never be outsourced. So I think it's a good time to be reviewing that kind of area in detail, and making sure that the transfer pricing policy that the group is adopting is fully aligned to this particular way of thinking around risk, and particularly that your documentation is clearly up to scratch and meets the new requirements around documentation. So I think at that point we will bring the session to an end. The slides, for those of you who want them, we will be making those available so people can access the slides, download the slides, and in particular follow the links through to some other presentations and webinars, etc., that are contained there. So I think it just remains for me to say thank you very much for all of you for participating. Thank you to Kevin, Holly and Thomas for joining me on the presentation, and we look forward to seeing you on future webinars.